Welcome to the Deep Dive. We're here to help you cut through the noise, really zero in on the essential insights from today's market-moving information.
Yeah, lots happening.
We're taking a deep dive into a stack of sources, a detailed market analysis report focused right on today, June 6, 2025, fresh data, recent commentary. It's all centered on the U.S. stock market. Specifically, we're looking at the fallout from the May 2025 U.S. jobs report just out this morning and, how the market's reacting to recent corporate earnings.
Right.
Our mission today is to unpack these sources, figure out the key, often conflicting forces battling it out, and pull out those important nuggets of knowledge, the potential strategies, maybe even an aha moment for you.
And it is absolutely a day that needs careful unpacking, this mix. You've got a major economic data release, the jobs report everyone watches for signals on the economy, on the Fed,
Right.
landing right alongside these individual company earnings reports. It creates a fascinating, sometimes contradictory picture. That immediate reaction to the 8:30 a.m. jobs number is significant for sure, but it's just one piece of the puzzle a source helps us build today.
Okay, let's start with the biggest piece then, the one really driving sentiment today. The May 2025 U.S. jobs report came out 8:30 a.m. Eastern this morning, June 6th. What were the headline numbers? What did the analysis highlight?
Okay, so the sources point to these key figures from the BLS report. First, non-farm payrolls. That's the main jobs number, right?
Yeah.
Excluding farming. It came in at plus 110,000,
Okay, 110K.
which was notably below what most economists were predicting. The consensus was around plus 125,000, maybe plus 130,000.
So miss.
A definite miss. And a clear deceleration from April's plus 177,000. Remember the weak ADP private payrolls report earlier this week? Only plus 37K. That kind of hinted this might be coming.
Right, foreshadowing. What about unemployment?
The unemployment rate saw a little uptick, rising to 4.3%.
Okay.
That's up from 4.2% in the prior months and just a touch above the 4.2% consensus forecast.
And wages. Always key for inflation watchers.
Wages also showed signs of cooling off. Average hourly earnings month over month were plus 0.2%. That was softer than the plus 0.3% expected.
Okay.
And year over year average hourly earnings, plus 3.6%. Also below the plus 3.7% consensus and down from April's plus 3.8%. So yeah, clearly decelerating wage growth there too.
So fewer jobs added than expected, unemployment ticked up, wage growth cooling. Okay, so what's the source saying about what this all means? What's the immediate takeaway for the market?
Well, the primary interpretation, and definitely the one the market seemed to grab onto initially, is that these numbers, taken together, point to a tangible cooling in the U.S. labor market.
Okay, and why is that so significant right now?
It's significant because a moderating labor market is, well, it's been a key thing the Federal Reserve has said they need to see. They need confidence that inflation will get back to their target sustainably.
Right.
So weaker jobs data like this, it just increases the probability in the market's view that the Fed could cut interest rates earlier or maybe more substantially later in 2025.
The classic, bad news is good news for rate hopes.
Exactly. Bad news for the economy potentially meaning good news for rate cut expectations, and therefore good news for stocks, at least in the immediate term.
And we saw that play out in the market reaction pretty quickly. The futures jumped.
Absolutely. Right after the report hit, pre-market futures turned positive. S&P 500 futures were up around 0.4%. Nasdaq 100 futures, lots of growth stocks there. Sensitive to rates, they rose about 0.5%. Dow futures up maybe 0.2%.
And the VIX, the fear gauge.
The VIX also indicated lower, down around 17.2. That's consistent with, more investor confidence, probably driven by those hopes of the Fed easing up.
Okay, so the initial read seems clear. Jobs cooling equals Fed cut hopes rising equals market happy. Simple enough. But the source also flags a pretty big counter-narrative, right? A conflict here.
Yes, and this is where it gets, more complex. While the jobs data looks cooling, there are these persistent worries about inflation coming from other places, specifically tariffs.
Tariffs.
Yeah.
Still a factor.
Still a factor. The analysis points to recent comments from Fed officials highlighting this. Governor Kugler, for instance, recently said tariffs will continue to raise inflation over 2025. And the San Francisco Fed has also put out views expecting a near-term rise in inflation because of tariffs, before maybe declining later.
So tariffs pushing prices up while the job market might be slowing demand down. That sounds like the market's being pulled in two different directions.
It really is. And you look at the latest inflation forecasts cited in the source, they add to this tension. The Cleveland Fed's June nowcasts, these are like real-time estimates. They project June year-over-year CPI at 2.67%.
Okay. And
core CPI, excluding food and energy, at 3.01%. Now, compare that to May's actual numbers, 2.40% CPI and 2.84% core.
So those forecasts suggest a potential uptick in inflation coming soon.
Exactly, a potential near-term uptick, which, certainly puts the Fed in a tricky spot, even if the labor market is cooling.
So the core conflict for you as an investor today, based on the source, is this clash. You've got a potentially slowing economy signaled by jobs versus these persistent price pressures highlighted by tariffs and those inflation nowcasts. This is where it gets really interesting. How does the source see these competing forces playing out, like today?
Well, the source actually lays out some high likelihood scenarios specifically for the next 24 hours reflecting this exact tension.
Okay, like what?
There's the soft landing confirmed dovish Fed scenario. They give that a 60% probability. That's where the market fully buys into the cooling jobs data, sees it clearing the path for rate cuts, and you get a decent rally.
The optimistic case.
Right. But then there's also a stagflation light hawkish pause scenario with a 30% probability. In this one, maybe the initial rally gets capped or even reverses a bit as the Fed or maybe other data points kind of remind everyone about inflation risks, maybe mentioning tariffs again. That leads to more choppy sideways trading.
So, leaning positive because of the jobs data surprise. But with that inflation worry acting as a pretty big but, what's the source's overall directional bias just for today?
Based on weighing those scenarios, yeah, the source's overall directional bias for the immediate 24-hour time frame is cautiously bullish.
Cautiously bullish, okay.
It favors the positive impact from the jobs report, definitely, but maintains that caution because of those lingering inflation concerns, and also, importantly, because of the really mixed signals we've seen from recent corporate earnings. That's another crucial layer here.
Right, let's pivot to that because the macro story is huge today, obviously. But the sources also dig into recent earnings reports. And these, well, they seem to paint a very different picture for individual stocks, sometimes contradicting that overall macro mood.
Absolutely.
Even when companies report strong results, the market's being incredibly picky, isn't it?
It's incredibly discerning, yeah. Earnings reports are where the rubber meets the road for individual companies, and the reactions show how fundamentals can just diverge sharply from or even totally override the broader macro story. The source gives some really clear examples from companies that reported just after the bell yesterday, June 5th.
Like Broadcom, ticker AVGO. They announced strong results, right? Beat on EPS, beat on revenue. They even guided next quarter's revenue slightly above what analysts expected. Talking up AI demand sounds great, but the stock, it fell.
It did, yeah. It was a surprising reaction. Broadcom beats Q2 EPS, beats revenue, guides Q3 revenue slightly above consensus, and yet the stock dropped about 3.5% to maybe 6.3% in after-hours trading. The analysis notes this could be a classic sell the news thing. Investors bought before the news, then sold afterwards. Or maybe investors are focused on something subtle, some unstated concern. It really highlights how high the bar is set, even for strong AI plays.
And Lululemon, LULU, similar story.
Lululemon, yeah, the apparel retailer. They met EPS expectations, slight revenue beat, okay. But their Q2 revenue forecast missed what analysts were looking for.
The guidance miss.
Exactly. Missing guidance is often punished, and the stock fell about 5.1%. A clear case where the future outlook just mattered more than the recent past performance.
And DocuSign, DOCU, that one got hit really hard.
Yeah, DocuSign, the e-signature company, they actually beat on EPS and revenue too. But the big issue, according to the source, was they revised their full-year billings outlook downward.
Billings.
Yeah.
Okay, that's important for a subscription business.
Crucial. It often points to future revenue. So that single downgrade in their forecast seems to be what drove the reaction. The stock just plummeted over 17% in late trading.
Wow.
And what's really insightful here, the analysis mentions this, there was apparently unusual bearish options activity on DSU before earnings even came out.
Really? So some traders were betting on a drop.
Suggests some sophisticated players correctly anticipated this big downside move. It's fascinating.
Wow, okay, that's a sharp confrontation of ideas right there. The macro picture, potentially looking better thanks to jobs, maybe suggesting rate cuts are coming, but then individual stocks just getting hammered on their own specific news.
Exactly.
This really drives home that aha moment. Even if the macro tide seems like it might be rising today, not all boats are getting lifted equally. Company-specific guidance, Even one metric like billings can totally override the bigger picture for that particular stock.
That's the divergence we're seeing. It absolutely creates performance divergence.
Yeah. But it wasn't all bad news on the earnings front, right? The source highlighted some big positive reactions, too.
Definitely not all bad. There were some significant positive movers highlighted as well.
Like MongoDB, MDB. That
Yeah.
stock just soared.
Yes, MongoDB, the database company. Strong Q1 beat top and bottom line, and they raised their full-year outlook. Crucially, they tied that strength specifically to booming AI-related demand.
Ah, the AI connection again.
That's a clear, positive, fundamental driver, right? Reinforced by the AI narrative market loves right now. The stock surged, 13%, 17% after hours and pre-market? Huge volume. Analyst upgrades followed too.
Okay. And on semiconductor, on in. Another positive.
On Semi drew attention because of positive comments from their CEO. Signaled improving demand in the semiconductor space, particularly for their power and sensing chips.
So a company-specific catalyst within semis.
Right, and that sector could also benefit if the market leans into a dovish Fed view boosting tech demand overall. The stock gained around 6.1% pre-market on that news.
Okay, so it's clear it's like a split screen today. You've got this potentially positive macro setup from the jobs data, fueling hopes for Fed cuts, meeting this very selective, sometimes brutal reaction to individual company earnings and guidance. The source also mentioned one other really extreme mover, MKD Welltech, MKDW.
Ah, yes, that's highlighted as something quite different, highly speculative. This stock saw an extreme pre-market gain, over 77%, huge volume.
Wow.
The analysis suggests this kind of move is likely pure speculative hype. Maybe short squeeze dynamics where traders betting against it are forced to buy back shares. It seems largely detached from fundamentals or the macro news we're talking about, and it's flagged as Nasdaq non-compliant, meaning it doesn't meet their listing rules. So extremely high risk, operating on totally different drivers.
Got it. So, okay, we have the big macro picture jobs, Fed hopes versus inflation worries. We have the micro picture, these selective earnings reactions. Let's pull back again. How do different types of analysis view this whole complex scenario, according to the source?
Yeah, looking through these different lenses kind of helps bring it together. From a technical analysis viewpoint, the source flags key resistance levels.
Like chart levels.
Exactly. For the S&P 500, resistance is around 59.90, 6,000. Now, why is that important? Well, if the market breaks above that decisively, maybe on good volume fueled by this jobs reaction, that would be a strong bullish signal. Could open the path towards the all-time high around 6150. But if it fails to break 6,000, stalls there, that could suggest the rally's hitting a ceiling and maybe caution is needed.
Okay. And the Nasdaq?
Nasdaq faces resistance near 20,000. Also, a lower VIX, like we saw initially today, that generally supports a bullish view consistent with easing hopes. But here's a subtle point. If the VIX stops falling or even ticks up while the market tries to rise, that could be a little warning sign.
Interesting. What about sentiment, trading patterns, quantitative stuff?
Yeah, the quantitative and sentiment analysis in the source notes that generally declining equity put-call ratios are seen as a bullish sign.
Remind us what that means.
It measures the volume of puts bets, the market will fall, versus calls, bets will rise. A declining ratio means fewer puts relative to calls, suggesting less demand for downside protection, maybe more speculative buying interest. And yeah, that options activity around MDB, the surge in calls before the jump, and especially DOCU, that weird bearish put activity before the plunge, those are cited as examples of, sophisticated positioning, anticipating big moves. And you see the sentiment feedback loop. Weaker jobs data hope for a dovish Fed encourages buying equities, which can improve sentiment further. It can feed on itself.
And the AI simulation, that added another wrinkle.
It did. The AI simulation in the source modeled how algorithms, those automated trading systems, likely reacted initially buying on the jobs data miss.
Okay.
But it specifically flags the potential for algorithmic whiplash.
Algorithmic whiplash, what's that?
It's the risk of rapid automated reversals. If something happens later, maybe surprisingly strong inflation data next week, or tough talk from a Fed official today that really pushes back on rate cut hopes, those algos that bought on the initial news could flip and sell just as quickly. It underscores how fragile that bad news is good news narrative can be sometimes. If the dovish signal isn't consistently reinforced, you can get really choppy trading.
Okay, makes sense. So let's circle back to those core conflicts we talked about. The source has to weigh all this evidence, the jobs data, the inflation fears, the earnings reactions, the technicals, and resolve these tensions to arrive at a final outlook.
Exactly. And based on the newest information, which is really that jobs report this morning, the source provides its resolution for those key conflicts, at least for today.
Okay, how does it see conflict one, the jobs data versus inflation concerns from tariffs?
For conflict one, jobs data versus tariff inflation, the source concludes the jobs data dominates for the immediate session today, June 6th. They assign this a 65% confidence level.
So jobs data wins out for now.
For now, yeah. The weaker jobs report is the most powerful new piece of information driving those dovish Fed expectations, and that's a strong market force. But they acknowledge that 30% probability that Fed talk on tariffs or inflation could resurface later today or this week and cap the enthusiasm.
Which explains the cautiously bullish bias.
Precisely. The positive trigger is there from jobs, but the known inflation risks mean you can't just go all in bullish without caution.
Okay, and conflict two, the potential broad market rally after jobs versus those specific stocks that got hit on earnings.
For conflict two, broad rally versus specific stock weakness, the source is highly confident here, 75% confidence that for those specific stocks with clear negative reactions to earnings or guidance, like DOCU's plunge, LULU's miss, AVGO's weird drop, their stock-specific weakness is likely to persist or at least cause them to underperform, even if the broader market rallies on the jobs news.
Now that really feels like the key aha moment for navigating today. Even if the macro tide seems to be lifting because of Fed hopes, that doesn't mean your specific stocks, especially ones that just disappointed on guidance or saw bad reactions, are guaranteed to float up with it.
Right.
The company-specific story can absolutely overpower the macro trend for that individual name.
It really underscores the importance of stock selection, doesn't it? Not just buying the index.
Definitely. So, bringing this all together, what does this analysis mean for you, the listener? What are the key strategic takeaways? What's the action plan the source suggests for navigating this market today?
Well, for someone with, let's say, a balanced risk profile, the source's strategic recommendation is to maintain that cautiously bullish bias for the short term.
Okay.
Lean positive overall, but don't get overly aggressive. The advice is to prioritize fundamentally sound growth names, companies that are most likely to benefit if the market does continue pricing in those Fed rate cuts.
And the analysis actually ranks specific opportunities based on all this.
Yes, based on everything we've discussed, their analysis ranks the top opportunities identified.
Okay, what's number one?
The Haxadar 1 rank is MDB, MongoDB, with a bullish view. Why? Well, as we said, that exceptional earnings beat and raise tied specifically to the strong AI demand narrative gives it really clear positive momentum.
Makes sense.
The suggested plan involves managing your entry point around that big post-earnings price gap with specific price targets to watch at $245 and $255. And importantly, a stop loss your exit point if it goes wrong around $228. The source gives this a high 70% probability for the bullish scenario playing out for MDB.
Okay, MDB number one. What's number two?
Hashtag 2 rank is NVDA, NVIDIA, also bullish. Why?
Hi.
Obviously a leader, right? And it has high beta, meaning it tends to move more than the market overall. That makes it particularly sensitive to any rally fueled by dovish Fed hopes and growth optimism.
So it could really run if the market likes the jobs data.
Exactly. The plan there is to watch for a decisive break above $142.50, with potential targets at $145 and $148, and a stop loss at $137.50. They give this a 65% bullish probability.
All right. And number three.
Hashtag 3 rank is on semiconductor, on in, bullish. Why? Those positive CEO comments we mentioned, signaling improving demand, that provides a company-specific catalyst within the semi-sector.
Okay.
And that whole sector could benefit from a dovish Fed view, potentially boosting tech spending. The plan involves watching for a break above its pre-market high, which was around $76, targeting $78 and $80 with a stop loss at $73.50. This one has a 60% bullish probability assigned.
So three distinct bullish ideas there. MDB on earnings strength, NVDA on AI leadership and beta, on in on a specific catalyst. What about that tactical bearish view on Broadcom you mentioned earlier?
Right. The source includes a tactical bearish scenario for AVGO as rank 4. This is based specifically on that negative post-earnings reaction. They see it as a potential sign of underlying weakness or maybe just extreme valuation sensitivity even to good news.
Okay.
The plan there would be to watch for a break below maybe $248, $250 with potential downside targets at $240 and $235 and a stop loss if it rallies back above $253. But, and they stress this, it's a higher risk trade.
Why higher risk?
Because you're essentially betting against the potentially positive, broader market sentiment driven by the jobs report today. So it has a 60% probability assigned to the bearish outcome specifically for AVGO, but you're swimming against the potential tide.
Got it. And that really speculative one, MKDW, where does that fit?
MKDW is rank 5, and it's basically labeled as purely speculative, extremely high risk.
Right.
The source strongly cautions it's likely driven by hype, detached from fundamentals, incredibly volatile, and remember, it's Nasdaq non-compliant, so really only suitable for very aggressive traders who use extremely tight risk management. They basically assign 50-50 bullish-bearish probabilities, just emphasizing the sheer volatility rather than any clear directional edge from their analysis.
Okay, that lays out the potential plays in the thinking very clearly.
Yeah.
So wrapping up the strategy, what are the essential final pieces of advice from the source for navigating this complex picture today?
Yeah, the source boils it down to a few critical recommendations for you. First, be selective. Don't just assume a rising market lifts everything. Focus on companies with those clear positive catalysts, strong fundamentals like MDB's earnings or NVDA's AI position. The divergence is real. Remember those earnings reactions.
I mean, don't buy indiscriminately.
Second, manage risk. Always use stop losses, like the specific levels they detailed for each idea. The potential for that algorithmic whiplash or just sudden sentiment shifts is definitely present.
Crucial.
Third, monitor closely. The sustainability of today's positive reaction. It really hinges on whether future data, especially inflation, and maybe comments from Fed officials today or soon, confirm this dovish interpretation of the jobs report. Pay very close attention to any Fed speak.
The story isn't over with this one report.
Not at all. And finally, focus on quality. Even within sectors you like, say technology, look for companies that might be more resilient to tariff impacts or those with proven pricing power. They might be better positioned if inflation proves sticky and the Fed's path isn't perfectly smooth.
That's a fantastic framework. It really brings home the key tensions, doesn't it?
Yeah.
The May jobs report definitely shifts the landscape, makes people think more about potential Fed rate cuts later this year, which is usually bullish. But that path is clearly complicated by these persistent inflation concerns, tariffs, those forecasts, and just how incredibly picky the market is being with individual company performance after earnings.
And that really is the core challenge today, isn't it? You've got a cooling labor market, a piece the Fed needs to see. But if tariffs are creating this separate kind of cost-push inflation pressure that the Fed maybe can't easily ignore, well, how much confidence can the market really have in a perfectly smooth, soft landing?
Yeah, that's the question.
If the Fed stays caught between trying to support jobs and fighting inflation that maybe isn't responding just to slower wage growth, well, the ride could certainly be bumpier than today's initial reaction suggests. That tension, slowing demand versus persistent cost pressure, that's definitely something for you to keep mulling over as the day and the week unfolds.
Absolutely. A lot of critical dynamics in play. Thank you for helping us unpack all of that from the source material. We really hope this analysis helps you clarify these conflicting forces and maybe spot some potential opportunities today.
Happy to help.
And to make sure you get the fastest, most frequent updates and analyses just like this one, please be sure to subscribe wherever you happen to be listening right now.
Stay informed out there and stay agile. It's that kind of market.
We'll dive deeper next time.